Other income. We will look at various kinds of other income, starting with alimony. We'll talk about bartering, debt forgiveness, disability payments, gambling winnings and losses, gifts and inheritances, recoveries, and scholarships. Alimony. Alimony is impacted by tax reform. Don't include alimony payments that are received under a divorce or separation agreement that is executed after 2018 or executed before 2019 but later modified if the modification expressly states that the repeal of the deduction for alimony payments applies to the modification. Note these rules do not impact tax years 2018 or before. Amounts paid to a spouse or a former spouse under a divorce or separation instrument, including a divorce decree, a separate maintenance decree, or a written separation agreement, may be alimony for federal tax purposes. Alimony is deductible by the payer spouse, and the recipient spouse must include it in income. To be considered alimony, the payments must be required under a divorce or separation instrument, among other requirements such as the spouses don't file a joint return with each other, the payment is in cash, the divorce or separation instrument doesn't designate the payment as not alimony, the spouses aren't members of the same household when the payment is made, there's no liability to make the payment after the death of the recipient spouse, and the payment isn't treated as child support or a property settlement. Not all payments under a divorce or separation instrument are alimony. Alimony doesn't include, as mentioned before, child support, non-cash property settlements, whether in a lump sum or in installments, payments that are part of a spouse's community property income, payments to keep up the payer's property, use of the payer's property, or voluntary payments. That is, payments not required by a divorce or separation instrument. Bartering. Bartering is an exchange of property or services. You must include in your income, at the time received, the fair market value of property or services received in bartering. If services are exchanged with another person and they both have agreed ahead of time on the value of the services, that value will be accepted as fair market value unless the value can be shown to be otherwise. Debt forgiveness. In most cases, if a debt is canceled or forgiven, other than as a gift or bequest, it must be included in income. There is no income from a canceled debt if it's intended as a gift. A debt includes any indebtedness for which the taxpayer is liable or which attaches to property the taxpayer holds. If the debt is a non-business debt, report the canceled amount on Schedule 1 of Form 1040. If it's a business debt, report the amount on Schedule C or Schedule F. Certain student loans contain a provision that all or part of the debt incurred to attend the qualified educational institution will be canceled if the recipient works for a certain period of time in certain professions for any broad class of employers. don't include a canceled debt in gross income in the following situations. The debt is canceled in a bankruptcy case under Title 11 of the United States Code. The debt is canceled when the taxpayer is insolvent. However, don't exclude any amount of canceled debt that is more than the amount by which the taxpayer is insolvent. A debtor is insolvent when the debtor's liabilities exceed the fair market value of their assets. Determine the debtor's liabilities and fair market value of assets immediately before the cancellation of the debt. Other debt that is not income: debt that is qualified farm debt, canceled by a qualified person. Debt is qualified real property business debt, cancellation intended as a gift. The debt is qualified principal residence indebtedness. However, this exclusion applies only to debt discharged after 2006 and in most cases before 2018. Disability payments. If you retired on disability, you must include in income any disability pension you receive under a plan that is paid for by the employer. You must report your taxable disability payments as wages on line 1 of Form 1040 until you reach minimum retirement age. Minimum retirement age is the age at which you can first receive a pension or annuity, if not disabled. Report as pension or an annuity if received after minimum retirement age. And note that it's not taxable if the premiums are paid by the taxpayer. Gambling winnings and losses. Include in income gambling winnings on Schedule 1 of Form 1040. If itemizing deductions on Schedule A, deduct gambling losses during the year, but only up to the amount of winnings. Only up to the amount of winnings. Gifts and inheritances. In most cases, property received as a gift, bequest, or inherited isn't included in income. However, if property received this way later produces income, such as interest, dividends, or rents, that income is taxable. If property is given to a trust and the income from it is paid, credited, or distributed to the taxpayer, that income is also taxable. If the gift, bequest, or inheritance is the income from the property, that income is taxable. All income the taxpayer would have received had death not occurred that wasn't properly included on the final return is considered income in respect of a decedent. Income in respect of a decedent must be included in the income of one of the following: the decedent's estate, if the estate receives it; the beneficiary, if the right to income is passed directly to the beneficiary and the beneficiary does in fact receive it; or any person to whom the estate properly distributes the right to receive it. Recoveries. A recovery is a return of an amount that was deducted or taken as a credit in an earlier year. The most common recoveries are refunds, reimbursements, and rebates of itemized deductions. There may also be recoveries of non-itemized deductions, such as a payment on a previously deducted bad debt. and recoveries of items for which the taxpayer previously claimed a tax credit. The taxation of recoveries is guided by the tax benefit rule. Include in income any recovery in the year it is received up to the amount by which the deduction or credit taken for the recovered amount reduced tax in an earlier year. For this purpose, any increase to an amount carried over to the current year that resulted from the deduction or credit is considered to have reduced tax in an earlier year. Federal tax refunds are not included in income because they were never allowed as a deduction from federal income. However, state tax refunds are often included in income if they are deducted from tax in an earlier year. Scholarships. A scholarship is generally an amount paid or allowed to, or for the benefit of, a student, whether undergraduate or graduate, at an educational institution to aid in the pursuit of his or her studies. A fellowship grant is generally an amount paid for the benefit of an individual to aid in the study or the pursuit of research. A candidate for a degree can exclude amounts received as a qualified scholarship or fellowship. A qualified scholarship or fellowship is any amount that is received for tuition and fees required to enroll or attend an eligible educational institution, or course-related expenses, such as fees, books, and equipment that are required for courses at the eligible institution. These items must be required of all students in that course of instructions. Amounts used for room and board don't qualify for the exclusion. Let's look at a few questions. Which of the following items may be considered alimony? A non-cash property settlement. Payments made under a written separation agreement for mortgage and real estate taxes on a home owned by the taxpayer in which their former spouse lives rent-free. Payments made to a third party on behalf of the former spouse for the former spouse's medical expenses, and payments made for the 3-month period following the recipient spouse's death. In this case, the only one that can be considered alimony is letter C right here, payments made to a third party on behalf of the former spouse for the former spouse's medical expenses. Non-cash property settlements are not considered alimony. Payments made by a payer spouse for property the payer spouse themselves owned are not alimony. If the property had been owned by the recipient spouse, then we could consider it alimony. And payments made after death do not qualify as alimony. Another question. February 2018, Paul and Jean, married couple, cashed a qualified Series EE savings bond they had bought many years ago. They received proceeds of $7,132. That came from principal of $5,000 and interest of $2,132. In 2018, they helped pay for their daughter's college tuition. The qualified education expenses were $4,000. They are not claiming an education credit for the expenses, and they do not have an education IRA. How much interest income can Paul and Jean exclude? Well, first, they're not using the $4,000 of their daughter's education expense for the credit, and they're also not using it for an education IRA. So that $4,000 can potentially be used to figure the non-taxable part of interest that from the cashing in of this education bond. Let's do the calculation. The interest was $2,132. The education expenses were $4,132, and total proceeds were $7,132. Take the $4,000, divide it by $7,132, come up with 56%. That would be line 2 divided by line 3 equals 56%. What that means is that 56% of the proceeds were used for qualified education expense, and therefore 56% of the interest is excludable. 56% of the interest, therefore, is $1,196. That represents the part of the interest that is not includable in income, or in other words, the part of the interest that is excludable. Let's think about a debt forgiveness situation. Trish works for a small retail clothing store. Her earnings are $26,000 during the year. However, she did not receive $500 of her normal $26,000 wage amount, but instead was given a credit of $500 on the outstanding balance that she owed to the store. In other words, the company, instead of paying her $500, forgave $500 of her debt to the store. How much is her income? Well, her annual wage is $26,000, but she didn't receive $500 of it. So the net amount received as wages, $25,500. Then add back in the $500 of debt forgiven to come up with W-2 income of $26,000. All right, our final question. This year, Brenda received a reimbursement of $800 for medical expenses that she paid last year. Total itemized deductions last year, $10,000. Standard deduction last year, $6,350. Medical expenses that she deducted after the 7.5% limitation were $500. How much of the reimbursement is taxable this year? In other words, how much was the tax benefit of the amount that she received? Well, she received $800 this year. Her medical expenses that were deducted were $500. So the smaller of the amount that she received, $800, and the medical expense deduction comes out to $500. Okay, so that's one part of determining tax benefit. Now let's compare total itemized deduction for standard deduction versus standard deduction. Total itemized deductions were $10,000. Last year's standard deduction was $6,350. So her itemized deductions exceeded her standard deduction by $3,650. So to determine tax benefit, we're going to compare $500 to $3,650. We'll use the smaller of those two and determine that she received $500 in real tax benefit of the amount that she had received as a reimbursement of $800, and therefore the taxable amount is $500. All right, well, thank you very much. I hope that this video was helpful.